Hey everyone, my name is Simon Mishevich from Entrepreneurship Accountants. This video, we're going to be talking about paying yourself from your limited company, or coin another phrase, extracting cash out of your limited company. So the first thing to look at is corporation tax taking wages. Now, the first thing you have to think about is corporation tax versus income tax. If you're going to pay yourself a wage from the limited company, then you will have an income tax liability on you as an individual. The company, however, does save corporation tax. But how much will you save? That's a great question. As for example, there is no point paying yourself a wage from a limited company if you are going to have an income tax liability of 40%, and yet the company will only save 19%. Does not make quite sense. So you do need to speak to your accountant to get some good advice on that one. We tell our clients that the best form of wages is $9,100, provided that you do not have any form of employment income anywhere else. If you are employed anywhere else, then you will have an income tax charge plus national insurance from both the employer and the employee from the company paying you those wages. So $9,100, providing you're not earning from anyone else, $9,100, just keep on re-emphasizing, means you do not pay national insurance as an employee or an employer, and you do not need to pay any income tax on those wages. The nice thing about paying $9,100, which you could actually pay yourself less, it does act as a pension saving for your UK state pension. Okay, so if you're putting $9,100, divide that by 12, you are actually adding money to your UK state pension, even though you're not making any employer or employee national insurance contributions. Now we could take dividends. Now, dividends is something that you are paid once the company makes profits. If the company is making a loss, you cannot pay yourself a dividend. So it is only out of profits you can pay dividends. So just be careful before you go into a tax strategy. You can take £500 worth of dividends each person each year, and they would be tax-free. So here I would like you to think about who are the shareholders of your company. I have seen some disasters where a person has a company, but their wife or husband or civil partner is not a shareholder. And that means that they do not have the ability to take out two lots of tax-free dividends. In this case, £1,000 between the two of them. Now, if you are going to take out dividends out of the profits made from the company, you need to think about these rates. This is over and above the £500 tax-free allowance. As basic rate taxpayers, so basic rate taxpayers being paid less than £50,000 as a total taxable income, will pay 8.75% income tax on dividends taken from the company. Now, what we also need to think about, well, let's add the corporation tax rate and the income tax rate C to see the total effective tax rate, because you do not get a corporation tax deduction for the dividends you take. That's because it is post-tax profits. So here we need to think about, well, you've had 8.75% plus 19% now gives you a 27.75% effective tax rate on that money. As high rate taxpayers, it gets much, much worse. So high rate taxpayers, someone earning more than £50,270 has an income tax charge of 33.75% income tax on those dividends taken from the limited company. The total tax rate, therefore, is 52.75%. How to get that? 19% corporation tax rate. Could be higher, by the way, of course, but I'm just giving you a basic example here. Plus the 33.75% now gives you 52.75%, which is a lot more tax. And you kind of think, well, why did I use a limited company? And that would be a fair challenge. If you're using a limited company but wish to take out all the money and wages and dividends, really, the limited company structure will not work for you. Additional rate taxpayers, well, forget it. If you're earning more than $125,000, then you need to think about this new income tax rate of 39.35%, which a total effective tax rate of 58.35%, which is adding 19% corporation tax plus the 39.35% income tax rate on those dividends. It is a lot of tax to pay. So really, you do need to be mindful of what dividends you take out of your limited company to stop this high level of taxation. Now, you can take interest from your limited company. Let's imagine that you set up the company you loan money to the limited company to get the business up and running, you can charge the limited company interest on the loan you've made to it, which is a good thing, because for basic rate taxpayers, you could get £1,000 worth of interest, which is a tax deductible for the company, but you can earn £1,000 worth of interest from that company and it'll be totally tax-free. So great way of doing that. Any additional amount above that 1,000 would be subject to 20% income tax, but the company would get a minimum of 19% corporation tax rate. So actually, you are only being taxed 1% over and above. So if you've got earning interest that you could earn up to £50,000, for instance, then you could charge it more than £1,000. You're only going to be paying an extra 1% tax, which is not a bad rate at all. Now, one thing you do need to think about is how much interest can you charge? I would say that you can typically charge a company between 6 and 10%. Why the degree of variance? And that's because of the Bank of England interest rate that keeps moving up and down, right? So you need to think about, well, what percentage? LIBOR plus what percent? Now, I would say that if you're charging your company 3% more than the Bank of interest rate, then I think you're pretty much on the nail there. High rate taxpayers, now the interest rate element is reduced from £1,000 to £500. So you can get £500 worth of tax-free interest from your limited company. And again, the company does get a tax reduction for that interest charged. Now, does it make sense if you pay yourself over that £500? Well, probably not, because you as an individual will pay 40% income tax on the interest charged to the company, and the company will only benefit from potentially a 19% corporation tax relief. So you're paying a lot more tax on those interest charges. And additional rate taxpayers, well, sadly, they don't get any allowance on interest at all. So any money that's taken out would be subject to 45% tax on those interests charged to the limited company. The limited company, again, will only get a 19% corporation tax relief. Taking pensions. Now, a pension that you have, you can make a 60,000 annual contributions, but it's not just you. Your company can also make a pension contribution on your behalf. This also reduces corporation tax. Again, a minimum of 19%, could be more. And it could reduce inheritance tax. The greater wealth that you have as an individual, the greater wealth that the limited company which is owned by you, therefore all of it would be subject to inheritance tax. But if you put the money from the limited company into your pension, it is free from inheritance tax. So that could be a huge saving of 40% of your net assets. Final thing is vouchers. You can take £50 worth of vouchers at any point in time, which is basically paid via the limited company to you. So one for all card allows you to make payments to high street shops, and the company can give you a £50 voucher. Now, thing about that is directors are limited to £300 per year. So you got £50, you can't take them every year because that would be higher than the £300, but you would take £50 maybe over the course of every 2 months, up to £300 per company director. And that would then give you £300 tax-free from the limited company, and you could go away buy presents. The vouchers do need to be non-cashable, so they need to be redeemed only by buying products or services.